There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice, brought to you by TackleTrading.com.
Justice podcast presented by Tackle Trading. My name is Matt Justice, along with my co-host Tim Justice. Tim, how are you today?
You know, I'm doing great. Matt. Now, a big day in the market today. I know that a lot of people listen to these backwards and don't know exactly what days we're talking about, but markets were up again today. Yeah.
You know, it's an interesting dynamic here because, you know, sometimes you just see it clear as day and sometimes it's not. Yesterday over there at Tackle Trading, I did a market prep video where I talked about what was going to happen in the market today. And I said, basically, guys, market's going to go up, dollar's going to go up, commodities are going to go down. And just so happened to be that today, that's exactly what transpired. And it wasn't that surprising, honestly. I mean, last night we got some news coming out of China that the Chinese were basically they gave an interview and the Chinese basically stated that they had not done enough to support the global recovery and the Chinese recovery. And I kept thinking to myself, shouldn't they say they haven't done enough to support the Chinese recession? But that was just kind of my own internal thought. What that means is they're going to, do more in terms of quantitative easing and, stimulus packages and whatnot, because let's face it, what else is anybody going to do in the market today? From the Americans starting this atrocity, horrific, asinine monetary policy to the Bank of Japan in December of 2012, and obviously the Europeans coming into this year and Chinese coming into this year. It's just every time we've seen it, and it's not just the U.S. Anytime anybody in the world mentions the whatever it takes, comments out of, whether it's Corrado or, Mario Draghi or Janet Yellen or whomever, what idiot economic savant says that next, their markets will praise it. They will praise the manipulation. They will praise the monetary policy that is creating one of the largest asset bubbles that we have ever not only seen in our lifetimes, but ever has been in the history of our economic system. So, good for them today. It's not going to last. It's going to end in a bloodbath, but good for them today.
Well, and I was talking to a group of investors from around the globe today, Matt, and I was actually talking about this. And there's a difference between short-term technicals. So some of you out there that are thinking about, well, how do I trade this? What do I do? Well, you trade the chart when you're doing short-term stuff. But the long-term fundamentals, you keep an eye on, the big picture, the news, the storylines, the way things are developing, the relationships between commodities, currencies, indexes, the whole thing. So you need both as an investor and a trader. And once you build both of those skills, it can be very powerful. But I had a request for today on the Trading Justice podcast. I want to go a little bit different route. I want to talk about a strategy that I've been teaching one of my students recently and kind of go through some of the basics of it, the mindset of it, the way that you would approach it, the way that I approach it, the way the market approaches it. And it's probably the best one out there for an investor. So after we get through monetary policy, then maybe we can just talk about the covered call strategy.
Well, the covered call strategy is a really, really good strategy, and we can certainly get into that strategy. But I do want to talk kind of what you said about short-term versus long-term. When you're studying short-term analysis, you are always trading the chart. Support, resistance, trend analysis, probabilities, confirmation, pattern recognition. It's all about just what the chart is. You don't care about what the central bank is doing. You don't care about the economic analysis, although you need to be aware of that because that will, economic reports will impact short-term trades. But at the same time, you really don't care about it. But you have to have an eye on the bigger picture. You have to understand what is happening out there in the marketplace, because if you don't, it's going to hit you like a tidal wave eventually. It might not be today, obviously not today. It might not be tomorrow or the next day, but eventually this bubble will burst. I mean, there's there is absolutely no doubt about it in my mind that this bubble will in fact burst. And I was reading a interview with basically, the one of the chief financial strategists out of some Swiss banking conglomerate. He's one of the leading experts in the world on monetary policy and you name it. He's sat on the Barron's top 20 roundtable for the last 25 years, right? Basically he was just saying, in looking at what the central banks have done over the course of the last 7-8 years, there's only one conclusion, that the bubble does in fact burst. And basically the question then became, well, if the bubble does in fact burst, where are you looking for gains? Where are you looking for, investments? Where are you looking to put your money? Because, with you and I, we can just trade the chart and, get in and get out because we hold that much capital in the grander scheme of things. But some of these financial institutions, Tim, they can't do that. They have to allocate over time. And basically what he was saying, he's like, if you're dealing with bonds in a rising interest rate environment with especially the U.S. bonds, you're looking to take a 5 to 10% clip in just if they just raise 1%, you're looking to take a 5 to 10% reduction in your bonds, so that you can't touch a bond right now. Do you look at U.S. equities? Well, U.S. equities are extremely overpriced, and being a European investor investing in the U.S., with the dollar being so strong, it's becoming more expensive for them to invest over here. So it's like with them already being so overpriced and the dollar becoming very strong, it's really hard for international investors to go into the U.S. markets. So, and then they're like, well, where do you go? He's like, well, you can go to commodities, but I see the commodities going down for the next couple of years at least. And he was referencing oil and gold and silver and commodities. And he said, well, you can always go to the U.S. dollar for right now.
You could buy Bitcoin.
You could buy Bitcoin. Interesting on Bitcoin. I'll get into that in a second. But you could always buy U.S. dollars right now, and you can always invest in European markets and whatnot. And it struck me for a second. And he was specifically talking about German companies. In terms of them, because when you look at the European markets, they're a little undervalued in comparison to the U.S. marketplace. And with the euro, being at $1.08 right now, it's a little cheaper to invest in Europe than it is over here in the U.S. And now that they're pumping in trillions of dollars into the European markets, that might be an opportunity over there. So really kind of his philosophy was for the next year to 2 years, invest in Europe, even though it's crashing right now. They're just starting their quantitative easing things, and also U.S. dollar. And I was just kind of thinking, I was reading that whole thing, and I was just like, I've been talking about this stuff for 2 years.
Yeah.
I mean, literally for 2 years.
Well, and that's a big thing. That's why I bring up what I bring up, because I teach a lot of people who have some of the same opinions that you're talking about. They're like, well, Tim, the whole thing may crash. The whole thing may drop. What am I going to do with my covered calls? Why am I going to buy stock? Why am I going to do naked puts when I'm walking into a market bubble that may crash? And I think it's a complicated question, and I'm curious to what your answer would be.
Well, when you're dealing with naked puts and covered calls, okay, those are short-term cash flow strategies. Those are monthly cash flow strategies. Nothing's going to crash in the next month. Okay, and especially with, say, the covered call, for example. The covered call on a lot of stocks, not all of them, but a lot of stocks and some of those commodity-based ETFs, as it does go down, you can offset your risk exposure by selling those short-term options against the stocks you own, so you're covering some of your risk exposure. For example, let's say you have a $50 company, Tim, and you sell a 52.5 call option against that $50 company. And you receive, 5% total premium because you're doing it in an individual account instead of an IRA. It's done on margin. So you're receiving 5% return. Well, in the next month, if basically what you're doing is you're covering 5% of your risk to the downside. And so if it goes down 5% the next month, you're still covering yourself by receiving 5% on the cash flow. Does that make sense?
Yeah. And a good analogy, Matt, is that if you drive on the road, there are risks, big risks actually, but that's why you got to pay attention, keep your hands on the wheel, and stay focused. Most of what we do in trading requires a short-term mindset in terms of execution, but a long-term eye on the big picture in terms of fundamentals.
Well,
even take the U.S. dollar, because you've been long the U.S. dollar a lot the last 6 months. Mm-hmm. Okay, you've been bullish on the dollar. You've been calling it on the podcast for a long time. You're not bullish on the dollar over the next 10 years.
No, in fact, I couldn't be more bearish on the dollar over the next 10 years. It's in fact, I read an interesting article out of Seeking Alpha just last night. It kind of frustrated me. It was like they were basically talking about the demise of the dollarization, which is basically the dollar being the reserve currency in the world, and they were basically saying, and honestly, Tim, they were talking about the SDR and the Chinese renminbi, and how it's going to take 60 to 70 years for this to price in. And I literally, my jaw dropped, and I'm like, listen, I've been telling people about the SDR for 3 years now. Okay, right. Welcome to the damn table, Seeking Alpha. Appreciate you coming to the party, and so. Right. But I'll tell you, when they look at the 60 to 70 year cycle, those traditionals like that, like the major publications and whatnot, they're not taking into account historical changes in technology. They're not taking into account speed of the market, speed of negotiations, and all of that jazz. I wrote about that in my Forex report today. But when they look at the 60 to 70 year output that's going to replace the dollar, they're basically taking a standard that was when the dollar replaced the pound. And so basically their entire argument was basically that the Chinese are going to overtake the dollar from a reserve currency perspective, either through the SDR or through the Chinese and the BRICS. Again, I swear to God, they might have been at my presentation last week. That's why they wrote about this. But at the same time, it's going to take 60 to 70 years, because that's how long it took for the U.S. to overtake the Brits from a reserve status. When you look at the economic values of the U.S. economy, they really became one of the leading economies in the world in the late 19th century. And then it took them about 50 to 60, 70 years until the Bretton Woods Agreement in 1944 to replace the pound. They became a debtor nation in 1914 after the dollar was created in 1913. And so even at that level, you still had 30 years before the dollar replaced the British pound from a reserve status. China became a debtor nation in 2009 with the introduction of the dim sum bond market. They're now the fifth largest reserve currency in the world. They're the second most utilized currency in the world. And so when I'm looking at the projections, I just look at what the Chinese have done in the last 5 years, not in the last 50 years. And by the way, the death of the dollar didn't start 5 years ago. It started in 1999 with China and Russia starting to move away from the petrodollar. But at the same time, you look at the speed of negotiations and speed of technology. You look at the world. We live in a global economic world, a global monetary world. We didn't live in that in 1914, 1900, 1930. We were more of an isolationist economic model. Now we live in a global model. It's already in just 2 years ago, the IMF, the World Bank, the United Nations all called for a new reserve status. Well, IMF called for a new reserve status in 2009. Reiterated it basically seemingly every single year over the course of the last 5-6 years. The BRICS have called for a new status. The Europeans have called for a new status. Obviously, the Russians are hooper and hollering and going and fighting and yelling and calling for a new status. I mean, this thing is happening right now. And Tim, my take on the SDR, the special drawing rights out of the IMF. I've been talking for 2 years now about how the IMF is going to include the Chinese renminbi in the valuation of the IMF SDR, which currently only consists of U.S. dollars, euros, yen, and British pound. And guess what they just announced yesterday? That they are going to include the SDR valuation, the Chinese currency. And that is to me, that is an absolutely immense, monumental decision. Even though from my perspective, it was expected, it is an immense, monumental decision, because for the first time, you're including a one of the outside the chief economic and military partners in that valuation, and so it's going to be interesting to see how that impacts. And I don't think the Chinese would fight for this if there was not already some degree of discussion, some degree of agreement that the SDR would be, because the SDR is used as a bond right now, but the IMF uses SDRs to funnel money throughout the entire world. And I do believe that the SDR will become a currency of trade. I think those debates and discussions and agreements have already been made. I think it's just going to take a little bit of time. And my projections have always been into the 2025 to 2030 range. And that's 10 years from now, Tim. So I certainly do not see it taking 70 years to replace the dollar. From the very beginning of the death of the dollar, from the 1999 petrodollar decisions to right now, we're already 16 years into this process. The last 5 years have sped up historically, and I just see this continuing to happen more and more until the dollar is no longer the reserve status of the world, and I believe that's going to be in the 2020s.
I believe there's a direct correlation between the amount of facts you just dropped and your golf handicap. I bet I bet that your golf handicap has steadily risen with the number of facts you've accumulated to be able to drop those like that. Where did your mindset change, Matt? Because we used to just want to go golfing all the time, but now you're driven by the knowledge and the power of understanding this stuff. And I mean, where did that come?
I totally get. I get what you're saying, and and it has risen a little bit. I'm much more of a hack now than I was 5 years ago, but I just don't get out golfing as much. It's about 5 years ago. I set myself a path that I just wanted to. Honestly, Tim, I was frustrated. Actually, I'll probably go 4 years. It was 2011, and I was writing a newsletter for Rich Dad. And I had just resigned from Rich Dad the year before, and I was writing a newsletter for Rich Dad, and I can't remember what I named the newsletter, but it was some degree of welcome to the end, in terms of this. And I started researching, monetary policy, and I started researching currency systems, currency wars to a certain extent. I started researching kind of what is happening out there because I was so frustrated with the Fed's quantitative easing policies back in once quantitative easing 2 really kind of hit the fan, and the market started driving down. And so this newsletter was like in August of 2011. And basically, I made the statement then that, and I've been against quantitative easing since the very beginning, but I made the statement then that it was in my estimation that what the Fed would have to do to prop up the market long enough is that they would have to basically print an extra $2 trillion. They had printed about $1.7 to $2 trillion at that point. Actually, it was about $2.3 trillion at that point. You had the first quantitative easing was $1.7 trillion. You had quantitative easing 2, which was $660 billion, and that kind of led from early on 2009, 2010 into 2011. So it was about 2.5 years. They had printed about $2.3 trillion. And I was just so frustrated with that. And there was a lot of rumors out there that basically the Fed was going to start another quantitative easing. And they didn't actually do it. They ended up doing a Operation Twist, which is basically a cover-called version of monetary policy, where they would basically buy long-term treasuries to sell short-term treasuries. And then they also did the dollar swap in December of 2011, which was probably, in my estimation, one of the most asinine, unreported, and dangerous things they've ever done. And that's when the euro was at so much risk compared with the European debt situation. And they allowed the European Central Bank to basically take U.S. dollars in exchange for euros and not pay a swap rate or an interest payment on it. Basically, we bailed out Europe is what we did. And so I was frustrated at the time, and I just, I wanted a degree of my frustration was because I didn't know as much as I thought I needed to know to really combat the ever-changing market environment. And so I just started diving into it, T. And you know what? I cannot tell you how many countless hours of research and study and debate and discussion and that I've had with in many capacities. But it's something that I'm passionate about, certainly, and it's something I would say. I don't like to, say that I'm an expert at that in any capacity, because there are certainly more smarter people than me. But at the same time, it's something that I know quite a bit about. And Tim, here's the simple truth: I haven't been wrong. That's just the reality. The things that I've been talking about, I said in 2011, they had to print another at least $2 trillion. They ended up printing another $2.2 trillion to continue to prop up the market. I've talked about the SDR. I've talked about the IMF. I've talked about the BRICS and what the Chinese are doing. And it's something that, and one of the reasons I do it is not just for myself. It's not just for myself, but also because the simple reality is we have a lot of students out there. We have a lot of students out there that, are frustrated and fed up to the same degree that we have been, when we started this journey in 05, 06 and coming out of resigning from Rich Dad in 2010. And so I feel a very special responsibility to make sure that our students, both the Rich Dad students that we've been dealing with for years and years and years, as well as our Tackle Trading clients and team members over there at Tackle Trading, that they are absolutely aware of this ever-changing environment, because they don't, and we preach this over and over and over again. You do not have to know everything when you have a team. You do not have to know every strategy. You do not have to know every technique. You do not have to know every routine, every management technique. You name it. You do not have to know everything about monetary policy and the like. If you have a team of professionals, like-minded individuals that are all working towards the same goal. And you know what? That's what we have over there at Tackle Trading, and that's what we're building over there at Tackle is to build a team of like-minded individuals that, with the ever-changing market environment, with what the central banks are doing and creating what, in my estimation, is the largest asset bubble that we will ever see in our lifetime, that we have a lot of people who are not only aware but armed with the strategies, the techniques to be able to combat this bubble to a certain extent. And quite frankly, at the end of the day, my mindset is that of a trader. If markets go up, fantastic. If markets go down, even better. We're going to be able to trade the price action. We're going to be able to profit in these environments. And, honestly, Tim, what I see in this largest financial bubble that we've ever seen, I see immense opportunity. I see immense opportunity in shorting the market eventually. Not right now, not when the market's in some degree of neutral pattern and bullish pattern, but when the markets break support levels. That's going to be an amazing opportunity to get out there and make money as the markets go down. And I see an opportunity in buying the dollar right now. I've been very bullish on the dollar over the last 6 months. I will be very bullish on the dollar over the next 6 months to a year, likely. And as the dollar goes up, commodities going to go down. But when the dollar starts going down, we have an immense opportunity in commodities like gold and silver and oil, as they will go back up. And when the bubbles crash, they will go back up. And, short market, short dollar, long commodities when the market is crashing, and while the market is going up, long market, long dollar, and short commodities. And it's not as simple as just that, because obviously things change, cycles change. But at the same time, that's kind of my approach to the market.
That's really interesting, Matt. And you're right. The team at Tackle is there to help people who may not have all of this knowledge to be able to take action, understand it, to see it. You want to put people in your life that can help you, understand the dynamic concepts that are happening out there, the complicated things, so that you can make a confident decision yourself. Now, wrapping all of that up.
Well, and honestly, that's so true, because these are very advanced concepts. I mean, when we're talking IMF, World Bank, central banks, ECB, FOMC, SNB, BOJ, Bank of London. When we're talking about all that, it's so overwhelming. It is absolutely so overwhelming. It's much more overwhelming than what a bullish breakout or what a bearish retracement is. But at the same time, Tim, if people are not aware of this, they're going to get absolutely crushed. They will be absolutely 100% just crushed. Their retirement's going to be crushed. Their currency value is going to be crushed. Inflation will spike in these events, and it's going to make 2008 feel like a walk on the beach. But if you are aware of these scenarios being played out, and we see them play out over not the next month, but the next years, the next 1 year, 2 year, 3 year, 4 year, then you can take advantage of that. Because in any one of the worst case scenarios out there, Tim, hyperinflation, you can benefit off that. You can offset your cost by trading in the commodities market. If the dollar goes down and loses reserve status, well, if we're short the dollar when these things transpire, then you can take advantage of it. And so that's why we do so much over there on a weekly basis is to make sure people are aware of the things that we see out there in the marketplace.
Yeah, I agree. And it does bring it back to that short-term versus long-term mindset, because we always talk about both. If you think about it, if you attend our shows or if you listen to this podcast regularly, we are talking about both. What's happening in the market today, what's happening in the market this week, and also the big picture to keep an eye on. And that's really the difference between fundamentals, technicals, and the investor versus the trader. I love this conversation. I love it. It brings me back to what I brought up earlier in the session, though, in the podcast, is that I've had a lot of students who hear the long-term concern and they have real hesitation taking the short-term action because of their long-term concern, whether it's covered call, which I wanted to get into a little bit, or naked put, or any other strategy. How would you talk to that student?
I would be blunt. I'd say, well, you have two choices now. You can either do something about it, or you can go run and hide and act like a child and get in the fetal position in the corner and get hit by it anyways. That's what I would tell them. And if you think I'm joking, what do you think I told the 50 students in Chicago this past week?
Well,
they said, well, man, how do we deal with that? I said, well, you can go get in the corner. Me and my students, we are going to go do something about it. The thing about it is, if you do nothing about it, then you're still going to get hit. You could go to cash. You could still get hit. You will get hit. Your dollar will decline and inflation will go up and you'll lose money. You got to learn how to do something about it. And yeah, do we have fear? Every one of us have fear. Every one of us have things that drive us a little nuts and a little scared and whatnot. But at the same time, maybe that's why there's, the 10% and the 90%. So if you want to be part of the 10%, if you want to be educated, if you want to control your financial future, it starts with a decision to start doing something about it. And honestly speaking, nothing happens overnight. There's nothing that I'm too concerned about over the next 2 weeks that's going to impact swing trades. So when you see them setting up technically, go do something about it. Is that a little harsh? Maybe a little bit, probably. I honestly don't care though. You can either do something about it or you can't.
No, it's not harsh. It's just the reality of being a grown-up and being an adult. There are things that happen in this world that you have to deal with. You have to confront. You and I, we got kids. We have, we're now, into our professions now for quite a while. We're entrepreneurs. We're developing our mindset. Anybody who's been through real stuff in their life, no, you have to just tackle it. You have to grab it. And I think that's the right mindset to have with this business, with investing in general, and being a trader.
And honestly, Tim, and I even told my group this past weekend, I said, it does drive me crazy that the American consumer is so damn lazy these days. It does drive me absolute bonkers that the American consumer can't get off their iPhone for 2 damn seconds to start opening their eyes to the things that are absolutely obvious out there. Okay, that drives me crazy. But at the same time, Tim, you look at the American mindset in history, okay, and we have proven time and again that when shit hits the fan, we will buckle up our bootstraps a little tighter. We'll tighten that belt a little tighter, even if it's a 38-inch belt instead of a 28-inch belt. We will tighten that up a little tighter, and we will go get the job done. And that's the American mindset. And if we can get back to some of that, then we're going to be just fine as a consumer society. There's going to be people that are hit very, very hard. There's no doubt about that. But you know what? We'll keep building. We'll keep swinging hammers. We'll tighten up the belt a little bit, and we'll go to work again. But for me, my mindset is I just want to take advantage of this. I see this asset bubble, Tim, as a way to not only set myself up for the rest of my life, but I see it as a way to set our children up for the rest of their lives as well. And I'm not going to miss out on that opportunity because I might be a little scared of losing some money.
Sure. Yeah, I'm with you 100%. So I am going to force us to talk covered calls at some point today. Because in the tag in our podcast, it's going to say covered calls. And I told the people to stay listening. This has been amazing, but I do want to talk about it a little bit. You ready for that?
Sure.
Why the heck not? Just what is it? Because I think it's a great strategy for a new trader. Tell people what it is.
It's a very conservative strategy. It's a strategy that new traders, veteran traders love. The covered call. Let me give you a little bit of an analogy real quick, Tim. Tim, if you own your home, okay, you know what a rental agreement is, right?
Yes, I do.
You know what a rental agreement is? Okay, you and I are gonna go and invest in a property. Okay, we're going to take out a loan for $100,000 on that property. We're going to get a mortgage for it because that's what most people do, and we're going to have $1,000 monthly payment on it. Now we are then going to rent out that property to somebody else. Right, we're going to charge them $1,500. Okay, so we have this property, total value of $100,000. We owe $1,000 on the property every month. We rent it out for $1,500. That is a rental agreement. Now, Tim, is that a good form of cash flow, rental agreements in the real estate market?
Yeah, I know people who
absolutely
who made a lot of money doing that. Yeah,
absolutely good. What is the only problem with the rental agreement? The only problem?
Well, I actually can think of more than one, but I would say the major one is that you're trusting the renter to give you the money.
There you go.
Number one.
It's tenants, right? That's number one. So number one, first problem is tenants. Tenants are filthy people sometimes, which means they don't pay their bills. They don't make it a priority. They sometimes dirty up the joint and mess it up, which means you have to come in and clean it. And then sometimes, the shingles come off the roof and you have to fix that. And sometimes you get a call at midnight because the heater went out and you got to take care of that. And so, just tenants and upkeep are two of the main problems. There's also another problem, Tim, especially right now. When you have a rental, when the market goes down over the next few years, what's going to happen to the valuations of property?
Well, they'll go down. Some investors would tell you they don't care about that. Real estate guys.
Okay, good. But why do they not care, though?
Because they have the property and they believe.
And they're renting it out, right? So they're offsetting their loss through renting it out. And so they're covering their expenses, they're offsetting their loss by renting out the property. And they're like, and even the most layman people out there, non-investors, they understand this agreement. They understand the rental agreement, they understand offsetting loss, and it's the exact same thing. Well, let me give you a different strategy for a second. Instead of buying a house and renting it out, or a property and renting it out, let's just substitute the house for a stock. Now, here's my agreement. You will always get paid every single month. Okay, you'll make a very similar degree of ROI, return on investment, or total cash flow every single month. But you'll never get a call from a tenant. They will never dirty up the joint. You can offset your loss as the market goes down through the renting of it out. Now, which one of those agreements is better, the rental agreement or my agreement?
Well, I do like your agreement.
I do too. You don't have to deal with tenants. You got guaranteed cash flow, and you get to offset risk to the downside. That's just the covered call, Tim. Yeah. We're going to buy a stock and we're going to rent it out. How we do that is by selling monthly call options against the stock we own. As the stock goes down, we're going to continue to sell more call options. And so each month we're going to continue to rent that property out. We're just not going to call it a home. We're going to call it a stock. It's the same agreement. And so when you put it like that, what's really to be scared of?
I think where it is for some people, is that they can physically see the house. They know where it is. Mm-hmm. Land they can step on. They know. Yeah. Right? There's something tangible there. A stock is a paper asset that they can't touch. But this is
true.
Where, like the ETFs come in, right?
Well, even outside of that, get over that. Who cares? Yeah. Most of the market is not tangible. Okay, when the Fed prints money, they don't actually print money anymore. They just change the decimal point. Okay, when you trade options are non-tangible products. But you know what? It's no different from buying a car. It's a product that devalues in time. An option is a product that devalues in time. So yeah, there is a mindset difference there. But the only reason that mindset difference occurs is because it's just new to somebody. It doesn't make it more difficult to understand if you start thinking about it. And I've told you this before. New doesn't make hard. Okay, just because you think something is confusing doesn't mean it is. It's just new. There's a vast difference between something being hard and really confusing and just new for it. And to kind of go on that, Larry Fink, who is the CEO of BlackRock, he said this in an interview last year that basically the American consumer, the only reason they are in business is because the American consumer will never put forth effort for their own longer term gain. This is Larry Fink, who controls $4 trillion worth of hedge funds and institutions and mutual funds out there. Think about what he said. The American consumer will never put forth any effort for their own longer-term gain. That is the only reason they're in business. So, yeah, it's a little confusing. It's a little new. Like I said, so what? Get over it.
That's right.
Learn it anyways. It's a simple strategy.
That's right. Get over it. Learn how to do it, because it actually is probably one of the most consistent long-term strategies when you look back at returns in the S&P.
Honestly, Tim, is probably the number one trade in the market over the last 25 years.
Well, in stocks, in equities.
In equities.
Yeah. I mean, when you go to the bigger market, there are others.
Carry trade's much bigger than that, but in the equities market, it's probably the number one trade. And the beautiful thing about the covered call, again, all you're doing is buying a stock and selling a short-term call option on it. The beautiful thing about the covered call is if you do this right, you will always be able to offset risk. You will always make more on the covered call than you will the stock itself. For example, Tim, let's take into account, just any stock out there. Give me a stock. I'm going to run some numbers for you. Give me a stock that you like.
I love Apple Computer.
Okay, let's look at Apple Computer. All right, Apple Computer currently priced at $126. That is Apple's current price. We're going to sell an option against Apple Computer, and we're going to get paid about $4. Okay, which is about 3.25% ROI in an IRA account. Which means how far can Apple go down next month for you to before you even lose a dime?
Give me the numbers again.
Okay, our ROI is 3.25. That's all you need to know. Apple can go down 3.25% before you ever care. Now, the first month you do this, you're like, well, 3% isn't that much. That's only $4. Apple can go $4 in 3 days. Well, yeah, it can. Anything in the world can happen. Don't think about the first month. Let's say we do this for 12 months total. Okay, that is a 40% return over the next year selling covered calls on Apple. That's not direction. That's just 40%, which means Apple can go down 40% in the next year. If you've been doing this for the last 2-3 years, you don't care where Apple goes.
Well,
because you've cash flowed enough on the stock to offset the expense.
That's right. And the other thing is the stock ownership. Apple's gained value.
Yeah. It's Apple's gained value in the last. We'll say we've been doing this for a year. Mm-hmm. Apple in the last year, if you look from 14 to now, Apple's went up from a $70 company to a $126 company. Now in the covered call, you're giving up some of that gains, right? Mm-hmm. Because you're selling the call options against it. But at the same time, let's say you've captured 10, 15, 20, 30% of that and whatnot, you've offset your gains even more. So again, you cannot think about the covered call just in 1 month. you got to think about the covered call long term because it offsets risk. And so the same thing occurs. In a down market, if Apple goes down, you're still going to write covered calls to offset the risk the same way you would still rent out your property.
Right.
But also, you're going to charge a higher premium to rent out your property in a bearish market, aren't you? And the same thing is going to happen here in the stock market. We're not going to get 3.25% in the down market. Volatility is going to go up, which means we're going to get more premium every single month.
Mm-hmm. Mm-hmm. Got it. I like it. I like it a lot. And I do believe that for a lot of people who don't need to have 50 strategies, because Matt, in your playbook and my playbook, there's probably 100 strategies that we know how to do, how to do confidently, know how to do well. Not everybody needs that. Not especially if you're dealing with your retirement or if you're dealing with a lifestyle issue where maybe you don't want to check the market every day. You and I mean, we have that energy right now. We have that drive. Some people don't necessarily want that as part of their vision. Now, I think you can check the market for 20, 30 minutes a day. I don't think anybody can't spend that time. But
if they can't do that, they deserve to get their money taken anyways.
Right. I think you got to at least commit to that. And that's the number I give people, especially covered call, naked put type traders, 20, 30 minutes a day. One of the best students I ever had, actually, was a little guy from Arizona. At the end of the day, in mentoring that, he would always say, "This is enough. Let's go golfing." And we literally, when the market bell rang, we'd go out and play nine holes of golf.
That's my kind of mentor student right there. The bell rings. Why are we still talking about markets when we could go out on the golf course and do this? Maybe I wouldn't be such a hack if I had more mentor students like that.
And I taught him how to do naked puts, which is very similar to the covered call. Maybe in a future podcast we can go over that strategy as well. But the point is, actually, he took one strategy, said, "Tim, I can't do more than just one thing. Give me one thing that you know is a good strategy for somebody at my age, with my account size and style and objectives." I said, "All right, let's do naked puts on good, fundamentally strong stocks that you don't mind owning." And we went through some rules on that. You can do just a few things as long as you're informed, educated about the big picture fundamentals. Tie this back to what you were talking about earlier. Stay informed about what's going on in the market. Just find a strategy that works for you.
Absolutely. Yeah. And you're right. You don't have to do 100 different strategies. You don't. But you have to master something.
Yeah.
Whether that's just the covered call or the naked put or credit spreads or currencies or whatever it is. We like to do a lot of strategies because we're in front of the market a lot. We're aware of what's going on every day, so we like to take advantage of it. But for other people who, are in different situations, whether they're, have a career or, they have a job or, they have other businesses, 20, 30 minutes a day is more than enough to do what you need to do in the market, Tim. More than enough.
And I tell most active traders 4 to 6 is a good starting point. But I think the analogy is really important. If you only can do one, not from time, but maybe even just skill set, maybe you practice 4 to 6 for a while, build that up to 8 or 10, but you go live with the first one you're comfortable with. You go live.
I agree.
You don't have to just jump into the market full bore and trade 50 strategies.
And you also don't have to jump into the market trading 10 contracts either. You can just do 1 or 2.
Yeah.
Do 100 shares. You're never gonna change your life trading 100 shares, but at the same time you're gonna get accustomed to, how the market works, how that strategy works. And at the end of the day though, Tim, you just gotta do something. Mm-hmm. You gotta get out there, and you cannot let fear hold you back, because it goes back to what Napoleon Hill said in Think and Grow Rich. In interviewing some of the richest men in the world, men and women, business people in the world of his time, they all said one thing: behind my greatest fear, behind where I thought I was my ultimate failure, one step beyond that was my crowning success, my ultimate success. And so, that's, to me, one of the number one differences between the rich and the poor, and I mean more in terms of mindset than I mean in terms of dollar figures, because to me, rich is not a dollar figure. It's just not. It's control of control of your financial future to me. But one of the number one differences that I say between the rich and the poor mindset is the poor give up. When things get hard, the poor give up. They say it's too hard. I'm never going to get it. And you know what? Just like they said, they never got it. The rich mindset, and this comes from Robert Kiyosaki, the rich mindset is one that continues to drive, continues to push, does not let failure stop us, because the one thing we all know is we've all had more failure than we could possibly imagine. But you know what, Tim? That's what makes us successful.
That's right. You've been listening to the Trading Justice podcast with Matt and Tim, and we've been talking about a lot of things, a lot about the future of the world reserve currency, fundamentals in the market, learning how to trade the covered call strategy a little bit, and the right mindset here. And that's what I love about, where we're at with this podcast, Matt. We're doing a lot of everything, but we're always enjoying the conversation. Last words for the team out there.
Last words for me is, in the last 4 weeks, we've had miss after miss after miss from an economic perspective. Today, the Atlanta Fed came out and said that the GDP of the U.S. economy growing at a paltry, balmy 0.3% in quarter number one. We'll get that economic report next month. That'll be interesting what the GDP of the U.S. economy came in at, and consumer spending down to 0.1%. Consumers are getting scared out there, Tim.
Yeah, I think so.
Oh, by the way, consumer confidence tomorrow.
I read a very interesting article at briefing.com last Friday, Matt, about the kind of strength of the U.S. dollar giving international investors confidence in the U.S. market, but it always hasn't played out that way. And so this quarter, with April earnings coming out, it's going to be really interesting to watch how that dollar...
It's going to be fascinating. Yeah. And I'm sure we'll be doing podcasts about the earnings and how this impacts it, but the dollar strength is not a good thing for U.S. companies. It's not as negative for small cap companies, small and mid cap companies, because they do a lot of their business just locally. So a strong dollar doesn't really kind of impact their bottom line because they allocate everything in U.S. dollars, and they also don't trade internationally in terms of international trade. But for your big dog corporations out there, the Apples, the Intels, the Schlumbergers, the Exxons, those big conglomerate companies, blue chip companies, that's what I'm looking forward to in this coming quarter's earnings. How has the dollar strengthening impacted first quarter sales? And so that's what I'm looking forward to. And my instinct, Tim, is they already know it's not going to be very good, and that's why you've seen a lot of headlines about it. So they're trying to set up some negative earnings.
Right. Go over to tackletrading.com, register, guys, get some of the access to the information that we put out there daily and weekly about markets. Download our Trading Justice podcast on iTunes. Give us a 5-star rating because we like that. It's going to pop us up the charts over time. Matt, Tim, we enjoyed it. Matt, I'm out.
You've been listening to the Trading Justice podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.